The Walt Disney Co. stock, New York Stock Exchange, DIS, is trading right now at $116.65, showing a gain of $1.80 or 1.57% in today's intraday trading session, as the market processes the latest set of financial results. Now, most investors looking at that headline price movement will see a solid green number and breathe a sigh of relief, assuming the turnaround narrative is firmly back on track, especially after a mixed year where the stock often felt like it was moving sideways. However, the real story here, the one you need to pay attention to, is the massive volatility we saw just a few hours ago, preceding this current modest climb. Disney's recent earnings report created a sharp, immediate downdraft, which saw the stock plunge significantly in pre-market trading, a classic expectation versus reality mismatch that creates both risk and opportunity. The fact that it has recovered so much ground, stabilizing into the mid-session positive territory, is the actual insight that requires a much deeper look than the simple closing price will offer. This rapid reversal suggests a powerful underlying institutional conviction that overrode the initial panic selling triggered by the revenue miss. The common understanding, the general market expectation for Disney, is that its immediate giant struggling to transition its hugely profitable legacy business, cable networks like ESPN and its cash-generating film studios, into a streaming-first world, all while juggling the post-pandemic recovery and rising costs in its parks and experiences division. The expectation is a slow, grinding process, punctuated by headline-grabbing successes like a major movie and sobering defeats like declining linear TV subscribers. The reality, as revealed in the small print of the recent quarter, is far more complex and leans into the structural advantages the company possesses. Yes, the overall revenue missed analyst estimates, a key point that initially spooked the market and caused that sharp pre-market drop. The decline in the linear TV business, the old guard of Disney's profits, continues to be a drag, and even the studio entertainment performance was weaker than some had hoped. This confirms the primary fear that the transformation is messy. But here's the contrarian take. The part of the business that matters most for the future valuation, the direct-to-consumer segment, showed a narrowing operating loss and continued, albeit slowing, subscriber growth. More importantly, the parks, experiences, and products segment continues to be an absolute powerhouse, exceeding operating income expectations and effectively buffering the losses and sluggishness in the media division. This dual nature, a struggling legacy offset by a robust park segment and an improving yet costly streaming arm, is what causes the stock's internal tension. When you look at the dramatic selling and subsequent aggressive buying today, it tells you that the smart money, those big institutional players who manage massive pools of capital, often through services like Fidelity Investments or trade frequently on platforms like Interactive Brokers, saw the initial price drop not as a confirmation of failure, but as an artificially low entry point. They quickly looked past the top-line revenue miss and focused instead on the better-than-expected adjusted earnings per share, the strong parks performance, and the explicit guidance from management projecting double-digit adjusted EPS growth for the upcoming fiscal year, alongside a commitment to substantially increase share repurchases. That last point, the planned share repurchase, is a significant signal of management's confidence in their own valuation and long-term free cash flow generation. It's a direct financial mechanism to support the Tesla stock or Apple stock price, and seeing a legacy media company deploy it aggressively is a strong buy-side catalyst. The trading volume today reflects this deep divide between initial market emotion and calculated institutional response. Volume has been significantly elevated since the opening bell, demonstrating heavy conviction on both the sell and buy sides, but the clear upward trajectory from the morning low to the current positive price indicates the buyers won the psychological battle. This kind of volatility is typical for a stock undergoing a massive structural overhaul where every quarterly report is a referendum on the CEO's strategy. You see similar high-stakes trading sometimes with NVIDIA stock after a major product announcement, though in that case it's usually growth expectations versus cost of production, whereas here it is a complete business model transition. The analysts who cover Disney are predominantly bullish, with a strong consensus rating and a median price target well above the current trading level. This disconnect between analyst optimism and the stock's relative flat performance over the past year highlights the core tension. The market wants to believe in the management's long-term plan, but the short-term bumps, like a revenue miss due to weak ad sales or cable subscriber declines, test that belief constantly. The recent price action confirms that the floor of institutional support is strong, and that for every retail investor who might be trading Robinhood fractional shares based on a quick headline, there are sophisticated funds using Fidelity's trading platform to build a position based on discounted cash flow models. They view the current environment as a cyclical low point before the combined power of Disney+, Hulu, and the eventual ESPN standalone streaming service fully kicks in. The macro environment plays a crucial role here too. The consumer discretionary sector, which Disney largely operates within, is highly sensitive to shifts in economic confidence. Theme park attendance and consumer product sales, while resilient now, could soften if the broader macroeconomic pressures, such as high interest rates or lingering inflation, finally force consumers to pull back on vacation spending. However, the international growth potential, particularly in its parks division, provides a crucial hedge against a purely domestic slowdown. The strength of the dollar and fluctuating international travel trends will continue to impact the translation of those international park revenues, which is a nuanced risk factor that gets less media attention than the latest streaming subscriber count. To properly frame the business, you have to understand the sheer breadth of the Walt Disney Company. It is organized into three core business segments: Disney Entertainment, ESPN, and Disney Parks, Experiences, and Products. Disney Entertainment includes the massive portfolio of film and television studios, content sales, and the direct-to-consumer streaming services, which are Disney+, Hulu, and the soon-to-be integrated elements of the ESPN platform. The goal here is profitability for streaming, a metric that has been elusive but is showing signs of improvement, largely through strategic price hikes and greater operational efficiency. The ESPN segment is wrestling with the structural decline of cable bundles, but the move toward a standalone streaming option for ESPN is the company's clear bet on the future of sports media monetization. If you are an individual investor managing your own portfolio, perhaps through a system like Schwab Intelligent Portfolios or taking advantage of SoFi Active Investing, you have to acknowledge that the traditional linear business is a melting iceberg. It still contributes a lot of cash, but it is shrinking. The third segment, Parks, Experiences, and Products, is the current financial engine. This includes the global theme parks, resorts, cruise lines, and consumer products licensing. This segment has been posting impressive results, driven by higher per capita spending, price increases, and strong demand for premium experiences. It's an asset that a pure-play streamer like Netflix simply does not have, giving Disney a distinct, highly profitable differentiator. Looking back at older performance, Disney has always been cyclical, tied to the success of its film slate and economic cycles affecting park attendance. The sharp downturn during the pandemic highlighted the fragility of the park business when forced to close, but the subsequent V-shaped recovery demonstrated the powerful pent-up demand for the Disney brand experience. Their long-term growth has historically been fueled by the continual monetization of their intellectual property, from Star Wars to Marvel to classic animation. The sheer volume of this proprietary content, which they continue to produce at immense cost, is their moat. It's an asset that is simply not replicable, which is why the stock is perpetually analyzed as a turnaround opportunity rather than a simple value trap. Shifting our focus to the future, the outlook for Walt Disney stock is entirely centered on execution and the market's patience. The key catalysts for upside are twofold. First, and most immediately, the successful and profitable launch of the standalone ESPN streaming service will be monumental. It has the potential to re-rate the entire company, proving that a major, highly watched cable asset can successfully transition to a DTC model without losing its premium pricing power. Second, the continued, verifiable profitability of the